sorry.
We're on, Nancy. Hello.
Here we are. Hey, thanks so much for joining us. I am so thrilled to be here with my partner, Arthur Laffer, and our special guest, Lindsey Bell. I've known Lindsey for a number of years. She's a familiar face on CNBC, Fox Business News, has been a strategist pretty much her entire career, was at CFRA with Sam Stovall, and then went to Ally, and now is at Chief Market Strategist at 248 Ventures. And I'm just so grateful that she agreed to spend time with us. So we're going to launch in. She's got some interesting thoughts on earnings, on jobs, on rates. So we're gonna step in and get started. So Lindsey, is there anything you want to start with before we start peppering you with questions?
Start there because when I look at earnings, I don't think it's going to be the catalyst that the market needs to kind of stave off the downdraft that we've seen.
That's not good news.
No, I mean, and the expectations, it's because the expectations are high, right? We're always looking for low expectations going into the earnings season. We're looking for 8.6% earnings growth according to S&P Capital IQ. As you mentioned, I worked there for quite a while, so there's the numbers I'm always looking at rather than FactSet. That's a really nice number for earnings growth. But, especially when you think about the GDP growth expected to be, at 2.7 is the current Atlanta Fed GDP now estimate. It all sounds really reasonable. And you might even say, hey, well, that's better than a double-digit earnings growth rate that we were expecting at the start of the fourth quarter. At the beginning of October, we were looking for 12.3%. So the near 4% pullback, it feels nice.
Yeah, and do you think that the GDP now number is underestimating the consumer in the way they calculate the number? I mean, it came down from 3.2% to 2.7, well, to 2.4, and now back up to 2.7. What do you think is a reasonable number? I know you're going to just be guessing like most of us, but do you have a sense that we'll come in above 3, or do you think we're going to be sub 3?
The conservative nature in me, and I'm not an economist, so yes, I'm kind of guessing, but an educated guess, I hope. I think we could come in closer to 3% because I think the consumer was, the early read is the consumer was spending this holiday season, and they were spending on discretionary items. They actually pulled back spending on non-discretionary. So I do think that the GDP number for the fourth quarter could come in better than expected. Look, the consumer has been resilient for the last several years, and I think everybody's waiting for the shoe to drop on the consumer. And I know we want to talk about the jobs report later, and I think that the fact of the matter is consumers are finding a way to make ends meet, and they're finding a way to spend. And I actually think the risk this week, Nancy, is greater in the retail sales number coming in hotter than expected than it is in the CPI data that we're going to get.
Oh, that's so interesting. Wow.
Yeah, I just expect the CPI data to kind of be in line with expectations, which are, by the way, are stagnant. When you look at core CPI at 3.3%, it's been there for several months, more than 6 months, if you kind of discount that 3.2% month that we had. You saw last week that the consumer is anticipating that inflation is going to continue to rise in the year ahead and the 5-year ahead period. So the consumer is acutely aware that food prices continue to go higher, shelter prices continue to go higher, even if there's been a little bit of a deceleration in that rate of increase. It's still there. The consumer is not comfortable with it. So they're finding ways to earn income and make money and spend it all on their own terms.
Well, and I know Arthur's going to have a question about inflation because he runs our dynamic inflation strategy and has for 15 years. But I just have one last question. So our friend Brian Reynolds at Reynolds Strategy, he looks at corporate tax receipts. I'm sure you do too. And to your point on earnings growth, they came in a little bit below the year ago period in Q4 after having, had 3 years of much higher than expected corporate tax receipts, which are obviously paid based on what earnings expectations are. So I actually think that you could be right, and that earnings they may be better than expected, but it may not be good enough, to your point. So anyway, Arthur, sorry. Just wanted to.
Well, Nancy, I was going to say, one of the things that you typically see really at year end with both the consumer and also corporate, if you think Trump's going to cut taxes next year, any expenses that corporations could have pulled from next year into this year, they did right at the end of the year. And same thing with the individuals. Like if you can bring an expense forward and move income into next year just one day, and you can drop your tax rate on that money. I mean, people do it all the time. There's huge timing effects in fourth quarter.
Yeah, that's definitely a powerful impact, and it's another good point about why the fourth quarter earnings season might not beat expectations to the historical average rate of 4.5 to 5 percentage points. So taxes are definitely top of mind and going to be key going into the year ahead, no doubt about it.
Yeah, that's a great point. Makes your point, really, Lindsay. So thank you, Arthur. Well, I'd like to know, I was reading over your notes. I feel like an anchor on CNBC. I was reading over your notes, Lindsay, and I noticed
You're doing a great job.
in this seat. There's no pressure. No, but
I was gonna ask a question because I don't know anything about earnings or stocks.
Go.
So I was gonna try to steal your thunder, Nancy, but I'll let you go.
No, that's a first. So on the jobs market, so we have a chart, I think that you haven't had a chance to really look at it, but it shows response rates to government surveys, and they've gone down dramatically. And if we get a chance, we'll throw it up on the screen. But then you have the revision of the 818,000 job overstatement.
They overstay the number of jobs.
God.
Yes, they overstate. They've been steadily overstating them.
Which would argue that productivity has actually been better than the numbers would show. But what do you make of all this? Like, how do you base any decisions on the jobs market? I know the market does every time we get a report, but as a strategist, do you smooth it? Do you wait to see a trend that's really definitive? Like what do we do? Oh, and there's the response rate. So you can see JOLTS is way, way down.
Yeah, these response rates, I think, and it's not just in jobs data. I think it's a lot of the economic surveys from the government have been revised in different ways because the response rates are so low. And I remember reading earlier last year an article in Barron's talking about this change, and it's because people, we're an online world, and I think the Labor Department and other parts of the government still do things the old way. But as far as analyzing this data and taking what it means from here, you can look at it so many different ways. A lot of people look at like 3-month moving averages. But to me, I like to just kind of look at where we've been over a longer term trend. I actually like to prefer to look at a chart like this and kind of surmise what it might mean, rather than just looking at one monthly data point or 3 monthly data points. I like to look at least a year's data. And one thing that I've noticed with the jobs data, you point out the JOLTS, the lower response rate. Well, the one thing about corporations is a lot of them are saying that they're excited and they're willing to hire and they're going to increase their labor force in the year ahead. And they've been saying this for some time now, and we're back to, it came down and now we're back to about year ago levels with their expectations for hiring rates. But they're saying one thing and they're doing a different thing, Nancy. The hiring rate based on real data and what they're actually doing is very low by historical standards, and actually a 3.3% hiring rate. That's more often aligned with an unemployment rate that's about double where we're at today. So hiring is very muted. Layoffs, on the other hand, are very low by historical standards. So that's a positive. And quit rates, while very low in the last month, in the month of December, they did tick up, at least in the BLS data for the monthly jobs report. I will say on the JOLTS data, which is November data, is the latest data that we have, the hiring rate, or excuse me, the quit rate actually ticked down while the number of job openings ticked up to, there you have it, 8 million jobs, right?
Wow.
And so while the job opening numbers, which most economists, and Art, you could correct me if I'm wrong, but I think most economists say that's not really the number we should care the most about. But still, the fact that they're putting more jobs on the open job boards, they're not hiring, and quit rates they went down in November, but they ticked up in this December monthly report. That makes me hopeful. To me, I've been characterizing it as this post-election labor market pop. I think companies got, pretty optimistic. When I talked to some of my recruiter friends out there, they got more optimistic post Trump's election in November. And it was an overnight change,
Right.
is the way they'll describe it, because all of a sudden we knew what tax policy meant. All of a sudden we knew what deregulation meant, right? And so I think there's going to be a spigot opening from a hiring perspective. I think the one downside to it could be just anticipation of what AI means from a personnel perspective. And I think companies are really struggling to think their way through it, and it might hold off on some hiring. So I think TBD, but I'm optimistic about the job market in the year ahead.
Yeah, Lindsey, you wrote, sorry, Lindsey, you wrote, I think about the components of the last labor numbers that came out. So like, I think we'd love to speak a little bit about where you see the hiring, where you don't see the hiring. Was there anything of surprise, anything you think that's either optimistic going forward, like something we were missing again, or something that you thought was a little bit of a surprise?
Yeah, so I think this month, just like last month, so November, December, again, talking about this post-election hiring pop that I'm calling it. What we're seeing is sectors that have stalled out for several months, for much of 2024, are starting to come to life again. So you're seeing finance and professional and business services sectors hiring again. Granted, they're still lower numbers. Professional and business services is a little bit better. That's engineers, consultants, administrative jobs, support roles, legal roles, all the above. Those are starting to increase. You're starting to see the jobs opening in the JOLTS report in technology tick up. So that's been a really
Wow.
weak sector, and there's potential that that could open up in the year ahead. Another sector that's really encouraging is recruiters. They're starting to hire more too in the last couple months. So that's obviously a sign that if recruiters are hiring people to recruit more, companies are hiring more. But also, it doesn't mean it's not coming at the cost of other sectors that have been our hiring stalwarts. So we've had healthcare and government. We've been able to rely on those two sectors over the course of much of this year to do the heavy lifting in the hiring and making sure that the job sector of the economy continues to chug along. And so that continues. And so there are certainly encouraging signs that we're seeing green shoots for the year ahead.
Wow, that's insightful.
I mean, I will say, look, it's not all like rainbows and sunshine and roses, okay? So I do think, again, getting back to the limited number of response rates to some of this data, you are seeing that you know, the number of multiple job holders is reaching levels on a per person basis above 1996 levels. So
Wow.
that's when moonlighting was all the rage. Everybody was a consultant, right? And still as a percent of the labor force, it's small, but the trend has been steadily and swiftly higher for multiple job holders. The other thing that we've seen is a switch between the number of folks in, and I should have sent you the chart, the number of part-time and full-time job holders. This last month in December, one of the positives was full-time jobs holders did increase, but so did part-time job holders, not as significantly as in the past. But when I look over the last 13 months, guys, 1 million jobs have been lost on the full-time front, and over 1 million jobs have been added on the part-time front. So I think that talks to a change in the dynamic and the economic forces. I think that folks are, with the job market pretty much stagnated, where companies aren't laying people off, but they're not hiring people either. And also promotions aren't necessarily happening, especially in what I call the experienced workforce level. So managers, the mid-level managers, there's not a lot of hiring. That is actually where the layoffs are happening.
Right.
So there's a lack of promotion that's a real phenomenon occurring. And I think that's partially driving some of this too. People are looking to make ends meet with higher inflation and things like that. So there's a change in dynamics. And I think that's a really good thing for the economy. I mean, Nancy, I know you talk about the mid 90s economic environment, the positives that could mean for the stock market. And I think there's a lot of trends alive and well there.
No, that's such a great point. And I think, to really try to decipher what's going on, because the numbers have been so unreliable, the government numbers, that is, the survey numbers, your anecdotal insight is really helpful also, because, I mean, as an investor, I think, the question is, okay, so then what do we do with this? Is this bullish or is it bearish? Is it good for margins? I personally think it is good for margins, and in particular the productivity. But Lindsey, where can people find your work? Because it's unique and insightful. And is LinkedIn, where do you publish most?
I'm most often publishing on LinkedIn, so you can just find me at Lindsey Bell on LinkedIn, 248 Ventures. You'll see all my stuff there and some of the different media work I do. Yeah, and I don't know. Thank you. That's a great compliment, Nancy. I try to come at the market from a differentiated and unique perspective, to find the data points underneath the surface, hopefully, that not everybody
Yeah.
sees.
And that's what we need. And we're going to take a break here in a second, but so it's Lindsey Bell just on LinkedIn. You just have to search. So now I'm going to go on LinkedIn, Arthur. And the other thing is, I wasn't going to tell you, but I really want to get a Saturday morning barista job at Starbucks, because I think it would just be great to have like just a task, right? Espresso, double espresso, ice,
At a discounted rate, right?
and not have to think about anything else. But we'll be back. We'll be back in a moment. Thank you, Lindsey. Hang on. We have about another 10 minutes with Lindsey Bell. All right. Thanks for sticking with us, Arthur. I'm going to let you lead for once.
In the quiet period in between Nancy getting herself put back together, we were talking about to Lindsey about one of the things about her view as to if it's not earnings growth, it's really going to be the driver like it was last year. What are going to be the drivers for stock prices ahead of us? So Lindsey, if you could comment on that, that'd be great.
So I guess I should correct myself and say that it's not that I don't think earnings growth is going to play a role. I think for the near term, the next couple of weeks, the fourth quarter reporting period won't be the driver of markets. But I do think that we're going to still get good earnings growth in 2025. We're looking for double digits now. I think that'll come in because usually we're a little bit too optimistic going into the first day of the year anyway. But I think we could still see about a 10% increase in earnings. And so that certainly will support market upside. I think the question mark, though, becomes where do we go with productivity? I know we're going to talk about that. But other than earnings growth, I think it's going to have to really come from either interest rates that do eventually come down because we're a economy that can withstand. We're growing and we can withstand a little bit lower interest rates. I think that's going to play a big role. I do think productivity plays a big role. And I just think economic growth in general, consumer spending is going to be an important part of it. And fiscal and monetary spending are going to be key.
Yeah, no, I agree 100%. And Lindsey, you referenced earlier that I've talked a lot. Some people say too much about the 1990s, but I think it's important and instructive because if you have productivity growth, then you can have a higher terminal rate from the Fed. So I think the Fed's been there. I don't know what data they're dependent on, but maybe it's the Fed funds futures. I really don't know because I think they've been 100% wrong for the last really 5 years, maybe even 6. Because remember, Chairman Powell has presided over 3 bear markets since 2018. But I do think productivity can really pull us along. And that would allow for lower employment levels. It would allow for better earnings growth and potentially better margins. But I think the latest number came in above 2%. That's the fifth straight quarter of above 2% productivity growth. Pre-pandemic, I think it was productivity is about 1.6. Year over year. So I'd love what your thoughts are. I mean, and the last thing I'll say is in the 90s, productivity peaked at 3.5 to 4% towards the end of the decade when, remember, Fed funds rate was above 5%, inflation was about 3. So if we get your double digit earnings growth, and I think you're right about that, and that's without any Trump tax cuts, by the way, which could really further spur earnings growth. What is your expectation in terms of how the market interprets all this data and what we do with it as we move forward into 2025?
So I think you're absolutely right. When I say 10% earnings growth rate for 2025, I think that doesn't include any additional tax cuts or any specific deregulatory policies that benefit specific sectors or companies. And it doesn't necessarily it doesn't take into consideration significant improvements in the productivity beyond that 2% from what we've currently seen. I think when we look at earnings growth across sectors, there's not a lot of AI productivity baked into a lot of those numbers. I think if we don't get that productivity gains, then we can't reach those 17% operating margins, EBIT margins that I've been looking at as the consensus estimate for 2025. And for the fourth quarter of 2024, that we're expected to see 16% margins, which we haven't seen since 2022. And when it was in 2022, part of what drove that operating margin rate was inflation, was in fact inflation and the prices being passed on to people in the lag time there. So margins were 16%. CPI averaged 8%. This fourth quarter is going to be 2.7. But companies have done a really good job in finding cost savings and kind of thinning out businesses. What I worry about, though, is while I am optimistic about the potential for productivity gains in the year ahead, and because I don't think that it's quantified right now because it's hard to quantify. But what I am worried about is that companies are indeed going to have to spend a little bit more. They're going to have to hire more because they've essentially been on a hiring freeze for the last couple of years. And that plays a role in margin impacts. That doesn't mean we can't stay elevated, because pre-pandemic, the historical operating margin was 14.5, 15.5. But to see 17% next year, we're going to need to see that productivity gain. And 17%, I think, can get us to greater than a 10% earnings growth rate in 2025, which then would be significant market upside, stock upside available to investors.
Yeah, I think you're right.
I was going to ask you about the dollar. So the dollar's been on obviously a continued tear here. Do you think that plays into anything that you look at when you're looking at stock prices, and who might benefit maybe disproportionately, like maybe import substitutes?
Yeah, so I think that the dollar obviously has been on a run, and that's a negative for earnings, right? Companies love to call out the strength in the dollar, especially multinational companies, right, that are dealing in different currencies. They love to call the strength of the dollar and the negative impact, and they never call out the opposite around, which is fine. We as investors know that, right?
Well, we do the same with our performance.
Right, you just manage to it, right? So I do think that that's going to be a negative impact for multinationals, but I think it creates this opportunity for the small caps, which also, by the way, have been beaten down in the last month and a half as well. So I think that there could be opportunity there for a multitude of reasons, given the recent performance. But yeah, so the dollar will be something that we have to watch through 2025.
Yeah, that's a great point. Yeah. Well, so have you made a market call on sectors, or do you not really do that?
I don't necessarily make calls, but what I do look for opportunities. And what I will say is, as fourth quarter earnings season unfolds, I'm definitely looking towards financials and the industrial sectors, because I think, again, like I said at the beginning of the show, it's all an expectations game, right? So expectations have been reduced significantly for these two sectors. And so I think that there is potential opportunity. And I know we haven't really talked about interest rates just yet. But I think the financial sector is one sector where there is opportunity, because if interest rates are going to stabilize or remain a bit elevated versus prior expectations, there's an opportunity here in this group. It's down almost 8% versus, a 3.5% decline in the S&P 500. And they're still expected to see earnings growth among the best for the fourth quarter at almost 16%. We got good results from Jefferies, and they basically said investment banking's on fire. They confirmed the expectation that deal making is going to pick up in 2025, whether it's M&A or IPOs. Favorable yield curve benefits this group, right? Bond spreads have remained quite narrow, and we just talked about how we believe the economic backdrop is on solid footing, and so is the consumer, the resilient consumer. So that, along with friendlier regulators, right, at the FTC, at the Fed, that's going to be a big beneficiary to this group. And I also think from a valuation perspective that their valuations are less stretched than other sectors. And so I think that there's just opportunity in this group, especially with like a 7.5% earnings growth projected for the full year.
Yeah, no, agreed.
Would you expect that? And I know we're saying this like air quotes, right? A more normal shaped yield curve. Like you look at going back to September when the Fed decided to start cutting rates, cut 50 basis points in their September 19th meeting. They cut 2 more times. Obviously we had an inverted yield curve for quite a long period of time with no recession, surprise. But you've got literally the yield curve starting to look like it's becoming much more of a normal shaped yield curve historically. Is that also going to be another big driver? Because banks tend to do a lot better, financial institutions do a lot better on the lending side when the yield curve is much more normal shape. They can actually price risk properly, as opposed to having to sit in cash and collect, get paid by the Fed.
Absolutely, you nailed it. I definitely think that the more normal shape of a yield curve certainly benefits the financial services sector going forward. And I think too, another point to make on the yield curve is the fact that it is positive sloping. It's a sign that, and it has been positive sloping, by the way, for several months now. And I think it was a question going into the third quarter earnings season, which is beginning of fourth quarter. If banks were going to be able to follow through, if the yield curve was going to continue to remain moving higher, and it has. That's certainly a win for the financial services sector. But I also think that the shape of the yield curve suggests that it's supportive of economic growth moving forward too. That's a telltale sign, right?
Agree. Yep. And I have a elephant in the room question. So we've had the Fed cut 100 basis points since September 17th. And the 10-year yield has gone up 100 basis points, give or take. Is there a risk? Is that a risk to all of our thesis that we're in a strong economy and a bull market? Is there a risk that the Fed has that the markets aren't listening anymore? The bond vigilantes have returned, and there could be a mistake. Now, again, 90s, we had 2 cuts in 95, and then they actually raised rates in 96, 97. So I'm just wondering, so it doesn't have to be deadly, but I'm wondering what you think about Fed policy and the implications for the bond market and stocks for that matter.
Well, it's certainly the fear that's spreading. I mean, in a sense, too, we saw at the beginning of last year in early 2024, we came into the market looking for 7 or 8 rate cuts, right? So I think what we're seeing now is like it's a big move, 100 basis points higher since the Fed started cutting rates. But I think it's a recalibration once again of the market really trying to anticipate what is the Fed going to do, what can the economy withhold. And so I think it's really this recalibration back last year. I think the market really also gets really uncomfortable when interest rates are above 4.5%, because we just this feels like unknown territory, right? Like I know you guys have a longer history in the market than say I do, but there's a lot of young folks, right, still in the market. And so I think it's really trying to kind of get an understanding about what higher rates mean for the economy, for consumers, and how it can be absorbed, especially with that productivity that could potentially be increasing. But clearly 4.5% is a place where we get really nervous. And that's what we saw in early 2024. I think that once we get through this, we get better clarity from the Fed, which, by the way, hasn't really helped us understand what they want to do with monetary policy, right?
I don't think they know, Lindsey.
I know, they know they're supposed to know. We're the ones that's supposed to be guessing, right?
Well, I think we have a question for you.
Okay.
Uh,
What are the biggest Q1 macro landmines for investors to keep in mind? And then Nvidia earnings, hot dollar. The biggest macro landmines, I think, is like we're looking for the black swan event. I think while the markets are, there's angst in the market right now about interest rates and inflation, and we were hoping this was going to be the year that we could finally focus on fundamentals. I think that those are the known unknowns, right, or the known risks in the market. I think you got to think like bigger than that. Maybe it's geopolitical risks ahead. What happens in China? I think you got to move outside of the U.S. to really see the biggest risks to the market.
so
I don't know. What are your thoughts on that?
Well, I was going to say, speaking of being outside of the US, I think you have to pay attention to what's going on in the Beltway, which is definitely its own universe. If we don't see, any kind of bill come, they've created expectations that it's going to be, Trump's one big beautiful bill or two not as beautiful bills, but it's going to get done by May, June. And I think if that fails, and I think we'll get a lot of volatility around that. But I don't think it changes the long-term fundamentals. I'm still bullish. I think we're in the early years of a sustainable bull market for many of the reasons we've talked about: earnings growth, AI, and the implications. I'll let Arthur weigh in, but the last thing I'll say is that John Chambers, who was the CEO of the poster child of overvaluation during, the tech internet bubble, has said that he believes that AI and that the internet was not nearly as important as AI and cloud computing, and that that there will be longer standing and lasting effects. But what do you think, Arthur?
I think people haven't counted on the fact that there's potentially a big peace dividend coming. Getting out, if Trump can really get us out of the war, and I say us, I mean really all of the developed world, because Europe is part and parcel, hugely exposed to the issues in Ukraine. You look at Germany's economy; they've spent tons of money. All of Europe has. They've made huge bets. So we can get that resolved to any kind of satisfactory resolution.
Right.
I think there's a huge benefit to spending for sure in Europe too. Although I don't think defense spending is going to stop anytime soon. It's like fool me once, shame on me. But that's a huge. I mean, think about I don't know how much money the U.S. has sent over there. It's what, hundreds of billions?
Oh, 10. Yeah, I don't know.
These are huge numbers.
Yeah.
And that's a big deal.
Okay, I have one last question for Lindsey, and you can have your final question. But what do you think about? So we've got the fires in California, got a ton of disruption. What is that? We know that it's tragic and devastating and will take years to repair. But what do you think that does to all the numbers in the short term? Do we get a distortion? People not working, construction spending obviously will go up eventually. But what do you factor that in, or do we just kind of go like this and hang on?
I almost think I hate to say it, that it's a hang on moment, because it is such devastation, and it's just completely, my heart and prayers go out to everybody there, but it's a big state. So I do think there's a potential for impact. And I'm sure all of the Wall Street analysts that cover companies that are, heavily weighted towards that state are, on top of it. But I think that just like the jobs data and some of the economic data after the storms that came through my part of the country here in Charlotte, North Carolina. We were safe in Charlotte, but other parts were much more devastated. So I think it's going to add to that volatility that you talked about, Nancy. But I do think that investors are going to be willing to look past it, because it actually brings up the opportunity for economic spending and an economic boom.
Yeah,
I think I've got a follow-up to that, Nancy. So really, now get bigger picture, real estate, commercial, residential. It's been a kind of the thorn in the economy for the last, I don't know how many years now. But what are your thoughts on real estate going forward with the change in kind of the market and the economy?
I mean, I think as long as interest rates stay elevated, and you look at the mortgage rates, back near that, I don't know where they're at today, but back near that 7% range of the 30-year, that's going to continue to weigh on the housing market. However, it's like the housing market's kind of like the job market. It's pretty stagnant, right? Nobody's moving. There's no change in hands. So as long as that's happening, I think we can be okay. Okay, but keep an eye on the foreclosure rates too. And I think if you're going to be in real estate, commercials probably better. And you got to get specific and dig in there because you can't just be anywhere.
Right. It's time for stock picking and sector picking. And yeah, I think you're absolutely right. Well, is there anything else you wanted us to talk about?
No, I think we've covered so much. We covered a lot of ground here.
You're amazing. It's almost like you're on TV all the time. Don't you think, Arthur? She's like,
yeah. Lindsey, it's great to meet you.
You guys
Nancy talks about you all
awesome.
the time. It's horrible.
You guys are
talks
too
about
kind.
me. It should be all about me.
Yeah, it should be. But Arthur calls me his annoying older sister. So that we have that
Arthur.
Well, thank you. Thank you so much. And again, just to remind everybody, go to LinkedIn, look for Lindsey's work, follow her, and you're on X also.
I am on X. I should be a little more active there. I'll work on it.
Good. We'll be looking for your posts on X. So thank you. We really appreciate your time and so excited about your new venture and just the way that you approach the markets and think about things. I'm working on a piece right now about how everybody just gets, on the air and says the same thing. And that, really, we have to be thinking ahead and carving out our space. And you've certainly done that today. So thank you.
Well, thank you for having me. This was really a great, insightful conversation for me as well.
Awesome. Well, thanks again. We'll see you
Thanks,
next week. Thanks, Arthur.
Thank you.
Okay.